Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. Probably the issue that is maybe after two international wars and what's going on in the United States, but the issue that domestically most of us are talking about, worried about, concerned about is real estate and what's going to happen. And I came across Danielle Foch, who is the host of the Canadian Real Estate Investor Podcast, some really interesting posts that he's put forward and some podcasts. So I thought it'd be great to check in with him and find out what he thinks is going on. Most recently, he had a really interesting post about the most important real estate themes for 2024 that I think we'll start with, but then lots of other interesting posts as well. Danielle's got deep experience in the real estate industry, and so I think it'll be an interesting chat. Danielle, welcome to the show.
Yeah, thanks for having me. Happy to be here.
So what are some of the most important real estate themes in 2024, if you could let us know?
Yeah, I would say the biggest theme in real estate for 2024 is credit availability. So whether or not banks are going to be lending money to people who want to invest in real estate, who want to buy real estate. And this is a theme that we're seeing across Canada and the US happening as a result of interest rates going up. Typically creates an environment in which banks, their costs go up as well when the Bank of Canada hikes rates or bond yields go up. And so and then once there's risk in the market, their willingness to lend money to people starts to go down. In the Canadian sphere, one of the big ways that this has been offset is through CMHC, so Canada Mortgage and Housing Corporation. Most people would know them for insuring mortgages for first-time buyers or for owner-occupied. So when people buy with less than 20% less than 20% down payment, they'll have to get mortgage insurance through CMHC. CMHC has a similar product for investors and developers who are building housing or creating housing called MLI Select. And so that's one thing that's really offset. And that's why you're still seeing strength in the multifamily residential market in Canada, especially.
So this is interesting. I can understand that the banks would charge more as interest rates have gone up, but assuming someone can pay that higher interest rate, are they still lending less as well?
Yeah, because I think we're in a risk environment and there's credit contraction, and also people can't afford it, right? So at new rates, like every time rates go up, fewer and fewer people can afford to buy a home and pay those mortgages. And so part of it happens as a risk mitigation, but a lot of it happens organically in such that, you're kind of reached a point where we're at. Housing affordability is about as bad as it was in the 80s and in the 90s, like 81 and 89. So we know what happened after those two moments in Canadian housing. And I think you would expect something similar to take place now. A lot of people are wondering, when is the housing market going to recover? When are people going to start buying homes again? Last year, we saw the slowest year since the early 2000s on the Toronto Real Estate Board. And the answer to the question is really people will start buying again when they can afford to buy houses, right? And right now, that's based on prices and interest rates and incomes in Canada. That's not anytime soon.
Remind us, if you could, what happened in 81 and 89, 90.
Yeah, so in 81, house prices ran up about 10% year over year for the 2 years leading up to that. So 79 and 80, about like 30% growth in a short period of time. And then they basically fell off 30, 40, 50%, depending on the market. They fell pretty sharply at the beginning and then slowly over a couple of years, from 81 until about 84, 85, depending on the market. And then, and that was at that period of time when things were really inflationary. A lot of people were getting into real estate to use it as an inflation hedge, and interest rates went to 18%, 21%, you were hearing on some mortgage rates. In an effort to curb that inflation. And so prices crashed similarly to what we're seeing in a magnitude of rate hiking today. Then basically shortly after that, in 84, prices kind of bottomed and they slowly started to graduate up. And as rates started coming down in 89, the cycle kind of repeated itself, where you saw even bigger jumps in house prices in 89. the average Canadian house price hit something like $275,000, and by 1990, on average, it had dropped 30 to 40%. Prices fell in from 89 until about 94, and then it took them until 2002 to recover on a nominal basis. So 12 years for house prices to go from peak to trough to peak again. If you adjust that for inflation, it actually took until 2012, 2013 for house prices to get back to their previous peak. So I don't know if that's really what we're going through right now, but I think a lot of the themes are similar, and the scale and magnitude of changes in the credit environment and affordability are equal. And so one could expect those outcomes to take place realistically.
So what do you think has happened? You know, I get emails probably every half a day about new price and assignment sales for condos and things like this. But yet I also get emails from real estate brokers that say housing sales are still doing okay. So what do you think has actually happened in 2023?
Yeah, so I mean, the data would say that sales are not okay. Like, I think so if you take 2021 was a record number of sales on the Toronto Real Estate Board. There's 121,000 sales roughly. And that'll probably stand as the long-term record. If you look at last year, there was just over 65,000 sales. So you've seen an almost halving of the number of homes that sold on the Toronto Real Estate Board in that 2 to 3 year period of time. So maybe they have different data than I do, but I don't know where one could argue.
If that's number of sales, that's one metric. But what about selling prices?
Yeah, sure. So if we look at prices, in 2022, we saw the largest drop in house prices in Canadian history from Q1 of 2022 until the end of the year in 2022. And then they kind of stabilized in 2023. And actually, we saw the strongest spring market that we've ever seen in 2023. If you were to measure house price growth from January until May, which is sort of the peak of the spring market, that was the most price growth we've ever seen in a 5-month period in Canadian history. So you saw this like serious volatility take place. And this is very similar to what happened in 89. In 89, prices dropped about 20%. And then in 90, they kind of ran up again because a lot of people were like, oh, this might be my last chance. Yeah. And so you get a bit of strength on the way down if the market responds and kind of whiplashes, and rates in early 2023 were relatively low. You could still get a fixed rate in the 4.5% range. Fixed rates are controlled by bond yields. So bond yields kind of came down in January, February, March, and there was strength in the spring market. Since then, the market's kind of flatlined, and there's just a limited number of buyers. And so you could expect, based on history, that price kind of follows volume. And if volume is low, then there's not a lot of buyers. And if we keep seeing sellers in distress, like you're seeing these emails of people offloading assignments at a loss or whatever it is, then you would expect probably negative price discovery could continue, right?
So you say that 22 was one of the highest increases, and then decreases, and then the spring of 23 was an increase. Any idea what the percentage was down in 22 and up in the spring of 23?
Yeah, so it would vary on a market by market basis, but if you use the whole of the Toronto Real Estate Board from peak to trough, so from the peak was in February of 2022, and the bottom was about November, December before things started picking up again into January. You're looking at about 20. And then the run up in the following year from January to May was about 10 to 12%, depending on if you're using average or median. And yeah, so you basically saw 20% off, and then 10% of it came back right away. And usually after May, you see prices kind of fizzle out throughout the summer and the flat line. And that's sort of what happened throughout the second half of last year. It wasn't a steep drop, but prices have kind of slowly grinded down since then.
And why do you think it's flatlined rather than continue to go down?
I think Canadians are really good at hanging on, to be honest with you. I mean, we take a lot of pride in paying our mortgages. People say that Canadians would give up groceries before they stop paying their mortgage. And I really think that that's true. I also think that banks are able to be exceptionally accommodating in this country. It's not like the US where, it's a highly competitive lending environment where if, one of your borrowers is behind, you got to cut it off really quick and foreclose on that property or whatever. We saw in the Liberal government's recent fall economic statement, the Canadian Mortgage Charter that they mentioned, which is really a set of rules that already exists, but we know, banks are able to extend amortizations as an example. They've done it already for people on static payment variable mortgages. But if you call them and say, hey, I'm experiencing financial stress, they'll actually extend your amortization, right? If you're in a situation of you have to declare financial hardship, but so they have such a big set of tools that they can help deal with borrowers. And I think that that's been a big theme is we've seen a lot of support. And then the other piece is most households haven't felt it yet, right? Like if you think about the distribution of mortgages, in 2025 and 2026, that's when all of these renewals are starting to come up. So you have, I think, 20% of around roughly 20% of mortgages renewing in 2025 and roughly 20% of mortgages renewing in 2026. And so, based on the vintages of those mortgages, assuming a 3 to 5 year term, you have people who would be renewing that got rates in 21, 2020, where rates were extremely cheap. So
You're saying that the pain might still be ahead of us.
it could be. I mean, based on a lot of the analysis from the Bank of Canada, I think that a lot of those households, regardless of what happens, I mean, even if rates come down, they're probably not going back down to where they were. So I think that there could be pain I don't think broadly, I think probably from an economic perspective, most of the pain is behind us, but I think for individual households, there's probably a lot more pain ahead. And I think a lot of people need to be doing the math on what their mortgage payment would look like if their interest rate was double what it was in 2020.
I agree. Daniel, where can people find your podcast if they're interested in listening?
Yeah, any podcast platform. We're on anything. If you just search the Canadian Real Estate Investor Podcast or on Google, just search it, and we have a website that you can stream the podcast right from within. We're on a network with the Canadian Investor Podcast for people who are into stocks and that kind of stuff as well. So
awesome. Well, we're going to take a break for some messages and come back in just 2 minutes with Daniel Foch of the Canadian Real Estate Investment Podcast, and have some more questions about what's going on in the market and what we might expect and what you and I can do with our mortgages and with our houses. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Where the heck the real estate market is going is the topic tonight, and my guest is Daniel Foch. He is the host of the Canadian Real Estate Investor Podcast. This guy has got some really interesting background that I think makes him very, very smart in this area. He was director of economic research with an organization called Rare Real Estate Inc. He's been the podcast host of the Canadian Real Estate Investment Podcast for the last 2 years. Before that, he was a broker in real estate market. He was a senior loan originator with Avena Capital. He was a research teaching assistant at the University of Guelph in real estate. He's got a Bachelor of Commerce in Real Estate and Housing from the University of Guelph and a Data Science and Real Estate diploma from the Massachusetts Institute of Technology. He's got a postgraduate certificate in property valuation from UBC. And fascinating, you were in the infantry of the Swiss Army.
Yeah, I was. I'm a Swiss citizen, so I got conscripted there. It's always interesting because they're, Canada and Switzerland typically ranked the top 2 places in the world to live, and definitely interesting comparison.
Now, your podcast and your research and work is both from a commercial standpoint as well as a residential standpoint. Is that correct?
Yeah, I mean, I do look at a lot of commercial real estate, but the reality is, I mean, Canadian commercial real estate is not an exceptionally robust market, and most of it's owned by large institutions like pension funds. And so there's not a ton of value in that research for the open market, let's say, as a private analyst. And so, and also, to be honest, even if you look at strip malls as an example, or shopping malls, most of them are being developed into housing, high-rise housing and stuff like that. And so everything kind of leads back to the housing market in this country. That's really a big piece of our economy in Canada.
So let's talk then a little bit more about housing. I would like to touch on commercial if we could,
Yeah.
you mentioned that we hang on in Canada to our housing
Yeah.
for a long time. One
Yeah.
of the big differences I understand between Canada and the United States is that in Canada, we have effectively recourse loans. In most states in the United States, recourse loans for housing are actually illegal. And so therefore they have what are called non-recourse loans. And so therefore in the United States, if your equity is underwater, you just give back the keys and you leave. And the bank can't come after you because the recourse they have is just to that house. The security they have is just to that house. In Canada, we give the security to the house, and a lot of us have signed these mortgages where it looks like effectively the house is owned by the bank, not by ourselves, and that we're buying it over time, the way the contract reads. But more importantly and greater risk to us is that they can come after us even if they take the house away from us and they're not paid out. Effectively, they can garnish our wages, they can come after us, they can bankrupt us, etc. And so that's one of the reasons why in the United States, in a downturn like we saw in 2008, 2009, owners just gave their keys back and walked away and started afresh. In Canada, you can't do that. Don't you think that's an important difference?
It definitely is, yeah. And I think that you see it a lot in the commercial market, where you have these large funds, like, even Canadian investors, like Brookfield, as an example. Like Brookfield walked away from a bunch of their assets in California and then literally just stopped paying the loan and gave the keys back, like you said, and forfeited their equity value. It's interesting because on to the downside, like it definitely slows how quickly prices can fall because you don't have banks taking possession of them, like, or getting them back from borrowers and then just trying to get them off their books as quickly as possible. But on the way up, I think it can also, it's a little bit of a moral hazard where, they don't really care as much if the asset is, or if the buyer overpaid for the asset, because it's not just the asset that is their security, right? It's the buyer that's their security as well. And so as long as the buyer believes that value is what it is, then the banks will often lend on it. And this is where you kind of get that, like, lending environment where people are able to buy houses for 10% more than the month before, which you never really saw that kind of, like, exponential growth taking place in the US. I mean, their bubble took place, but it took a long time to form. Whereas in Canada, you get these really big rallies. Like 2017, we saw it. You got this rally where you're like 20+% year over year growth, and then it crashed. And then 2019 came around and you were kind of flatlining. COVID started and rates went down, and you saw this other one form, and then it crashed. And so from the price perspective, I think this recourse environment here has created a lot of volatility because the banks have two security mechanisms and they are a little bit more detached from the valuation of the home, right?
Yeah, I think what we've done is created a system where really the people are more at risk, the banks are less at risk. In the United States, the banks are more at risk, and so therefore they have to think about lending to a greater degree because the risk is just the housing. Second question, I understand that one of the big differences between Canada and the United States is that the length of the amortization of a mortgage, and that while we have terms that are 3 to 5 years, as you stated, we have amortization periods that are longer than typically held in the United States, and that a lot of people in the last year or so, when interest rates have gone up, have actually had negative amortization, such that the amortization period gets longer because their payments have stayed flat. Can you comment on whether you think that our amortization periods are too long, and that this negative amortization, what do you think of it?
Yeah, so I would say probably amortizations are appropriate. I wouldn't like to see them get any longer than where they are. But I don't think you could reasonably make them any shorter. I think when you talk about negative amortization, so that really only exists with what should be a small portion of mortgage products, but a lot of people rushed into this product during the pandemic when people were getting into these variable rates. So that's a static payment variable rate mortgage where the person has hit their trigger rate multiple times. And basically the bank, so when you're in a static payment variable rate mortgage, your payment stays the same even if your interest goes up. So over time, you're paying more and more interest. Let's say your payment's $2,000, and at the beginning of your mortgage, your rate is 1%. So you're paying, $1,800 in principal and $200 in interest. Now all of a sudden the rate goes up to 5%, which actually happened. That happened to a lot of mortgages. Now you're paying $2,000 in interest and $0 in principal. And so this
Well,
is
hold it. Let me
where,
interrupt. Actually, worse than that, you're paying if your example of 1,800, you're paying negative 200 in principal, and that
yeah,
principal is getting added to the back end and
yeah.
increasing the length of time in the amortization.
Yeah, exactly. And this is where you have it's fascinating from my perspective because it's technically outside of the scope of the Bank Act in Canada. So like it's almost a violation of what's actually allowed in lending. But I think that, these are exceptional circumstances. And so lenders were allowed to accommodate. I think OSFI, the Office of the Superintendent of Financial Institutions, has been pretty good about trying to get these unwound. But also making it clear that that product will likely never exist again, and nor should it, right? I mean, it's a big problem. And so I think those mortgages are basically gone. The question is, what do we do with all of the ones that are, as you say, negative amortizing? And I think a portion of them, you might have borrowers who can afford to pay it, and that's great, and they'll switch into another product on renewal. But a lot of them can't, and that's where you get kind of the question of this long-term effect of rate increases. Again, even if all of the banks are correct and rates are in the 3.5% to 4% range by the end of the year this year, that's still substantially higher than the 1%, 1.5% that people were borrowing at in 2020 and 2021. And so all of those mortgages, as an example, still have to renew over the next 5 years, as do the fixed rate mortgages. And so do we have this sustained impact where you get a lot of people renewing and saying, oh, I can't afford this payment, I got to sell? And you start flooding the market with supply. And that's really where for the past 2 decades, Canadian real estate has never really entered a buyer's market. You'd always had excess demand from population growth, immigration, new household formation. And now all of a sudden we have a lot of supply and not a lot of people able to buy houses because they can't afford mortgages right now.
You can't afford it. Let me ask you a third question, if I could, about this situation that we're in, and particularly how it compares to the United States. I understand that in Canada, we have a far greater amount of people that are in floating rate mortgages rather than fixed rate mortgages. And that certainly is cheaper when interest rates are low at the short end of the curve, but gets a lot more expensive in today's market. Is that correct?
The distribution would be there's more people in fixed rate mortgages than variable rate mortgages. I think something like 30% of the market is in variable rates, but we did see, and this is where the problems begin, so in 2021, it was the first time that variable rates were greater than 50% of new originations. So something like 60% of borrowers in 2021 were taking variable rates. So and then you had in Toronto Real Estate Board record number of sales, so 121,000 sales at inflated prices, right? Prices 10-20% higher than they are right now. This is where you've got people who bought homes in 2021 on a variable rate who have maybe hit their trigger rate, or they can't afford the payments, or they're up for renewal, even if they bought on a fixed, and they don't have equity either. This is kind of where the problems begin, right?
I agree. I think that, number one, the use of variable rate interest rate mortgages went up, but it's also a lot greater in Canada than it is in the United States. And so therefore, when we look at the United States, it's sort of an example of what's going to happen. It's not the best example.
Well, it's fascinating because like one of the big things in the US in 08 was these adjustable rate mortgages, right? Where you had a rate for 2-3 years and then it switched to another rate. All of our mortgages in Canada are like that, right? And so like I do a lot of these Twitter spaces where I have a lot of people from all over the world talk about real estate. And whenever I get people from the US, and I've had notable guests from the US on the Twitter spaces before, we talk about it and they're like, oh, you guys don't have 30-year rate holds like we do in the US, because they have 30-year rates right now. Like, and anybody who bought during COVID and bought with a 3.5% 30-year mortgage, like they're set for life. They just need to, they probably won't want to move because their rate's so good, but they have an excellent mortgage payment. Here, we got to deal with that problem every 5 years. And it's, for the past 20 years, it hasn't really been an issue because rates have generally been trending down or relatively stable. Now, all of a sudden, we're entering this new rate environment where rates are going up, and there's, 4 times higher or 3 times higher than they were when a lot of us got our mortgages. We're starting to really deal with some issues. And to me, the problem at the core of all of this is Canadians are really bad at saving money, and we pile on a lot of debt. Like we have, depending on the month of the year, we have the highest household indebtedness in the world. So highest household debt to disposable income in the world, 118%. That's regardless of what happens with rates, that's a huge problem because Canadians still have to pay all that debt back before our economy can grow. The rate just means that it costs us less to own that debt for the period of time that we have to hold it, but we still got to pay it back.
Well, that was true in the past when the rate was low. It's not true today with the rates higher. It still costs. It does cost a lot to pay it back. And I think that, another couple of differences between Canada and the United States is that in the United States, they have mortgage interest deductibility up to a certain level. And so therefore this interest that they pay that's comparable to our interest is deductible against their taxes for the average household price. In Canada, it's not. So we're effectively paying twice as much with the same interest rate in after-tax dollars than the United States, than America has. And then I think finally, in 2008, 2009, they had a big depreciation, a big decline in their real estate prices that we didn't have in Canada. And so therefore, when you take a look at sort of real estate prices over time, they had big growth, and we hear lots of commentary in the American news about housing prices up in the United States as well, so that they're suffering from some of the same things that we're suffering from, but from a far smaller base, because they had this big 30% decline in 2008, 2009 that we just didn't have. And we just continued going up since then. So I think that there's a lot of challenges that we've got in Canada. Your comment about 20% of the mortgages coming due in 25 and 26, I think that's true, but it's going to be about almost that in 2024 as well, because of your comment about most mortgages are 3 to 5 years, and so therefore, if it's even every year, it should be between 33 and 50%, and the only reason why it's not is because 2019 sales were less than, as you pointed out, 2020 sales, and the other sort of benefit to 24, or the reason why 24 isn't going to be less impactful, is because prices were lower in 19 for those people that are coming due in 24. Prices ran up in 20 and 21, as you indicated, and so therefore 25 and 26 are going to be really tough years, but 24 should be as well, because a lot of those people that took out mortgages in 2019 or in 21 or 22 if they're in 20 or 21 if they're in 3-year mortgages are coming due in 24 at far higher rates, and they're going to get hit
for sure. Yeah, absolutely.
So I want to take another break, and when I come back, I want to ask you how we got into this problem. Like, sure. what got us into this very tough situation? Not knowing exactly what's going to happen coming out of it is one issue, and we've talked about that in regards to rates and prices and volume, etc. But we need to understand how we got into this situation if we're ever going to try to fix it. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. Our topic tonight is the real estate market in Canada, particularly the Greater Toronto Area, because that's of interest to a lot of my listeners. Our guest is Daniel Foch. He is the host of the Canadian Real Estate Investor podcast. Daniel says you can get it sort of wherever podcasts are available. He's on LinkedIn, and I follow him there, and he posts a lot of his commentary on LinkedIn, as well as links to his shows. And this man is one smart guy in the real estate business, and so I recommend him to you. Danielle, we've talked about the volume of real estate sales, which you've described as being down. Prices that you described in the last half of 23 being flat. That you're worried that with mortgage renewals and interest rates that haven't yet come down, that we might suffer some future declines, and we don't really know, but I tend to agree with you on that. But let's turn, if we could, to, I think, a really important issue about how the heck did we get into this situation? What do you think caused this current situation?
Yeah, so I think it's a variety of factors, but primarily I think we didn't you were describing this correction that took place in the US in 08, 09. We didn't sober up during that period of time when they did, right? They stopped the addiction to credit, and we just started ours. Canadian central bank had dropped the rate to similar to what it was during the pandemic, for the first time ever, and they realized that there weren't a lot of economic consequences to that, and they kept the rate low, and kept rates low in Canada a lot longer than the US did. And so Canadians just kept piling on debt, and that's how we ended up with the highest household indebtedness in the world. So that's probably the core issue. I think there are some other issues. I think that we have an economy that's globally regarded for being a good place for laundering money, and real estate's an exceptionally efficient way to do that. I think that would be certainly not helping. I think it introduces irrational consumers to the market, where people are buying real estate not because they care about the value, but because they have some other motive. And so again, when you have people who are detached from value, prices can accelerate a lot more quickly. You have the same thing where you're hearing about it being a shelter for foreign investors, whether it's a political shelter, or a lot of people just want to get into Canadian real estate because they consider it to be a safe and stable asset. That was a big theme 2016, 2017 in Vancouver and Toronto, where Vancouver in BC, they ended up banning foreign investment. And in Toronto, they did the same thing. And during those periods of time, it was estimated that like one in three purchasers of property was a foreign investor from China. And that period of time, the big reason that capital from China especially was interested is they like real estate, and their market was running up 60%. Shenzhen, China ran up 60% year over year in that year, 2015, 2016. And so to come here and say, oh, Canadian real estate's only going up 20% year over year, so that, it's a bargain. And that introduces a little bit of irrationality to the market. So that's another component. And then I think population growth in Canada is on par with, if you look at the list of the top 10 countries by population growth, it's mostly emerging markets. So you have like Syria, the Congo, mostly African nations. And then Canada is in there at 3.3% year over year population growth. And a portion of that's from immigration, and another portion of that comes from non-permanent residents, so temporary foreign workers and international students. And we're not building as many houses as these people need to move here. So on an average basis across the country, there's 4.7 new Canadians for every new house being built. In provinces like New Brunswick, that's something like 11.3 new people for every new house being built. In Ontario, it's 5.3. In BC, it's 3.5. So there's a big spectrum, but we aren't building as many houses as there are people, or the population is growing. And so this creates excess demand. And in a lot of cases, you start seeing combining of households, which means combining of capital, which means people can pay a little bit more money for a house, as an example. And so those would probably be the major issues that I think when all combined. I mean, independent, I don't think any of them would be a really major problem, but I think when you start stacking all of them, it gets us to where we are right now.
So it's interesting. A lot of what you said, increased demand. So you said, number one, that low interest rates were an important point, because we could afford more, and so therefore we demanded more, and we allowed prices to go up. Number two, you talked about immigration. Number three, you talked about foreign buyers. Number four, you talked about people combining families, and that would give you more buying power, and that would increase. But you only once mentioned supply, and I really think supply, or lack thereof, is one of the major contributors. And you said there's not one thing by itself that impacted it. I kind of think that supply might be that one thing. We are building as many houses in Canada today as we built in 1970s. 1974, I think, was the year that people take a look as the benchmark, because it was one of the highest years in the 70s. And we're building the same numbers today, even though we've doubled in population. So, you've got the academic background. Economics 101 is supply and demand. What do you think? Is it demand or is it supply?
I think demand's an easier problem to solve, but I would agree with you. Yeah, I mean, had we had a supply solution 5 to 10 years ago, we wouldn't be in this mess, right? So I completely agree. Like, the underbuilding is a big issue, and I think it'll prove to be a lasting issue because you can't solve it instantly. Like, a lot of the policies that the Liberals are putting into place, and don't get me wrong, like, they've done some great work over the last 6 to 12 months since the polls started reflecting how big of an issue this is for them. And those policies are probably just doing the next government a favor, because you're not going to start realizing the impact of them until 5-10 years from now. Housing supply is such a long run solution, and it's such a long run problem. And so the reason I think that, and maybe it's easy for me to point to demand, because demand to me is like, you could just limit the number of temporary foreign workers or international students, which the government's talking about doing now that they're under fire for these policies being inflationary. Whereas supply, and I'm going to be speaking at the ResCon conference this week, actually, which is a residential construction industry conference. And, in a room full of people who are capable of solving this problem. And the biggest issue that they're facing is labor shortages as a result of, if we look at the policy on this came from the Bank of Canada's website, of the 500,000 people who immigrated and got permanent residency in Canada, only 455 of them were through the skilled trades stream. And
hold it. You're saying of the 500,000 people that immigrated to Canada, only 455
yeah, correct,
were skilled trades. So that's not, that's like 0.01%.
Yeah. And then when you look at temporary foreign workers coming to Canada, about 3% of them are working in the construction industry, whereas of the general population, about 8% is working in. So there's a big mismatch in labor and labor supply, and which needs to be solved before you can even start thinking about, because right now you have the government going around, and the federal government going around and basically I'm not bribing, but giving municipalities financial incentive to upzone their cities. So Toronto went to 4 units, London, Ontario, BC just did up to 4 to 6 units depending on the location. And this is great. Now you have hundreds of thousands of units in the pipeline. Who's going to build them, right? So you've just taken the bottleneck from planning and moved it to construction. And the challenge is on the planning side, it's not really getting that inflationary, because you don't have planners or municipalities bidding on getting these units approved. Once you move it to construction, if you take all of that demand and move it to construction, it could actually have a further inflationary cost on, because now all of a sudden you've got last year you had 100,000 units in the pipeline. This year you have twice as many. And now all of these construction companies can say, oh, well, I can charge you whatever, right? Because I got twice as many customers. And so this is probably one of the big risks for whether or not we can. So I would agree with you. You're absolutely right. Supply is the core issue. It's just the most difficult one to solve.
And this federal government infrastructure money that you're talking about, I think people misunderstand it. Maybe you can explain it to us. The money that they're granting, is it to build homes, or is it to build only affordable social housing?
Yeah, so I guess there's a couple of different components. So if you're looking at the federal government's National Housing Act program, they're giving money for infrastructure. So to basically fast track the infrastructure to build the houses. So like water, sewers, in some cases, transit, roads, whatever, in order to unlock that supply. If you're talking about the CMHC program, where the CMHC is ensuring purpose-built rental housing financing, that really is targeted towards, there's three components. So there's accessibility, there's environmental and energy efficiency, and then there's affordability. And so it's like a point system. If you were to rank highly in all three of those categories, you would get 100 points, and that would allow you 95% loan to value mortgage, and 50-year amortization, which is wild on a rental property construction. If you're rank 75 points, you kind of get a little bit lower than that. So it is definitely becoming more and more targeted towards creating affordable housing on the purpose-built rental side. We're not saying any incentives to create affordable ownership. I think, and this is where it becomes a really long-term conversation and a good comparison to Switzerland, where their home ownership rate is like in the 40% range. I really think that, I don't, whether it's a policy objective or not, I think that the Canadian dream of home ownership is just eroding, and we're heading towards a renter's economy, right?
The home ownership dream is eroding. That's not something that a lot of politicians are going to get elected on if that's what they say.
Yeah.
So, I think that this federal government involvement is helpful. There's just no question about it. And it does fund infrastructure. It does fund some social housing. And it has been the incentive or the catalyst to getting some of these as of right zoning rules changed, such that people are going to be able to, take a single family home and make it into a triplex or a quadplex. But that's not going to be where the majority of housing supply increases come from. BC has recently changed the rules around major transit zones such that that developers and other people would have an as of right to build a minimum of 20 stories if they're within 400 meters of either a transit station or even a bus exchange, which I think is really interesting. In the Greater Toronto area, we've got planning that would restrict the height of buildings. Do you think we should do something like what BC's put in place?
Yeah, I think you've seen it proposed in Ontario Bill 23, which has kind of gone on the back burner a little bit as a result of some other political things taking place around housing in Ontario. So, but they had proposed MTSAs, major transit station areas, in the Bill 23 for Ontario. And the municipal government in Toronto has proposed, well, they have municipal MTSAs, but they're so those exist within 500 meters of transit, has been upzoned, I think, to 6 to 10 stories. I can't remember the exact planning. There's a great municipal planner you can have on here, Greg Ewens. He used to work with the city, who could probably answer all those questions for you. But the provincial MTSAs would increase that even more. When that's going to take place, probably after, I think, a lot of this Greenbelt stuff blows over, maybe.
I think it's a big issue. I think that we dramatically need to increase supply. And I don't think the federal government can impact that much, though the things that they're doing are great. I think the provincial government needs to do those things that, as you indicated, were in Bill 23 and some of the other bills that they put forward. I think the Greenbelt fiasco was a complete fiasco and a mistake. But I do think that the governments that we need to look at are the municipal governments that have allowed a zoning planning regime to be in place that has dramatically restricted development. And it's a mistake. And I think it is the entities that should take the blame for eroding that homeownership dream that you mentioned. And I think it's a real travesty. Anyway, we're going to take a break for some messages and come back with some concluding comments in just 2 minutes on what the heck are we going to do with our real estate market, and what can you and I do as we struggle through these challenges of mortgage renewals, higher prices, whether prices are going to come down, when's the right time to buy, etc. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Daniel Foch. He is the host of the Canadian Real Estate Investor Podcast. Daniel, you said you can get those podcasts on whatever podcasts are available. And also, I follow you on LinkedIn. Do you have any other recommendations as to how people should best access your intelligent ideas and podcasts?
Yeah, thank you. I think if people just Google my name, I'm fortunate enough to have a unique last name. So usually Google will usually present you with the platform that you're most likely to want to follow me on. But I try to be everywhere. I'm on YouTube, I'm on TikTok, Instagram, Twitter. So find me wherever you're, whatever you like to consume your information on.
Or on the Brian Crombie Radio Hour, and we got to have you back because this has been a good conversation. Let me finish off and ask you two questions then.
Sure.
Given this sort of uncertain environment that we've described, where interest rates are higher, some people think by the end of the year they might come lower, where we got housing prices that you've described as being flatlined, but some people think might come down, and volume that is clearly down. Provincial governments, federal governments, even municipal governments that are talking about increasing supply, but as you say, that takes a long time for it to all happen. What should governments do right now? And what should, people listening that have got houses and mortgages, what should they be thinking about doing right now? Should they be buying? Should they be selling? Should they be sitting still? Should they be renewing mortgages? Should they be extending amortization? Give us some advice at both what governments should be doing in today's market and what people should be doing.
Yeah, so it's kind of the same advice. I think that governments really need to. So I think they've done a great job with incentivizing large scale supply. So through the MLI Select program that I mentioned, but also through reduction of HST self-assessment on purpose-built rental and a lot of this upzoning, and that's great. But it also it doesn't, maybe not rewards, but it really only helps large scale developers and large scale investors, people who have enough money to build these. But the challenge is what I mentioned with the labor issue is you still have a bottleneck there where it's very specialized. You're talking about concrete construction or large scale construction, steel, more sophisticated types of development. I think that in order to really make a lasting impact, we need incremental changes. And that's where we've seen it. We've seen a lot, like Toronto being a great example. You have Toronto being upzoned to 4 units. We need comparable credit products that are available to the large scale developers for small scale owners and developers, because we're at a point where you can't make a single family rental house work in 90% of markets in Canada. And so investors need to create new housing. They need to maybe cut a house into 2 units or 3 units or 4 units. But that CMHC product that I mentioned earlier in the show, that only exists for 5 or more units. And once you start getting into 5, you need a more sophisticated, more sophisticated drawings, more sophisticated team to build it. You need sprinkler systems. You need typically, it's not as easy as a house that has 4 units in it, right? And so I think that there's this gray area somewhere between 2 and 5 units where the government could bring a lot of supply on the market, where somebody, right now we have, this is a very interesting statistic. We have the 3rd largest square footage per capita in the world. And a lot of that is held by, baby boomers who only use 10 to 25% of it. And the question is, what's going to happen when we see all of those people transition out of those homes and that supply starts getting absorbed by people from my generation who have lower space demand, right? Most of us are used to living in 1,000 to 1,500 square feet max.
Or 500.
Right. And so the idea is a lot of the supply that we need could already exist. It's just we have a square footage allocation issue. And so the opportunity that I see for people who want to invest in real estate, and this is like, we're training people to do this right now. We have a course where we basically teach people how to convert existing houses into multiplexes. That's really where a lot of the value is being created as investors. It's probably the only way you can really make an investment make sense right now at current rates and prices. And I think that if the government really, if they wanted to flip a switch to get a lot more supply built overnight, that would be it, because it's way more agile. To add a basement apartment takes you a couple of months. To add a high-rise building takes you a couple of years, right? And so
that's fascinating. That's really interesting. We only got a minute left. What about people?
I think that people who want to make money in real estate need to solve a real problem. Like, it's not like interest rates are going to push house prices up for the next decade the way that they did. So the big problem here, the glaring issue, is the housing crisis. And the way that we solve that is the same way that I mentioned the government can. It's creating units, taking houses that are too big and cutting them up into units that are just the right size.
Thank you very much. I really appreciate it. It's been a fascinating conversation.
Yeah, my pleasure.
Remind us the name of your podcast and where we can get it.
Yeah, the Canadian Real Estate Investor Podcast. It's available on every podcast platform, Spotify, Apple Podcasts, etc. That's our show for tonight, everyone. Thank you for joining us. I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. And all my podcasts are also available on those same
podcast services, as well as on my website, briancrombie.com. Thank you very much for joining us. Good night, everybody.
Thank you.